So, financial liabilities at fair value through profit or loss. So, an entity may, at initial recognition, irrevocably designate a financial liability as measured at Fvtpl. When doing so, eliminates or significantly reduces a measurement or recognition inconsistency that would otherwise arise from measuring assets or liabilities or recognizing the gains and losses on them on different bases, or a group of financial liabilities or financial assets and financial liabilities is managed and its performance is evaluated on a fair value basis in accordance with a documented risk management or investment strategy, and information about the group is provided internally on that basis to the entity's key management personnel. So, how do we measure the financial liabilities at Fvtpl? So, initial measurement of financial liabilities at Fvtpl would be at fair value. So, any transaction costs or bond issuance costs directly attributable to the issuance of the financial liabilities related to the FL at Fvtpl will be expensed outright. Just like when we record a financial asset at fair value through profit or loss, particularly the trading securities, if you can remember, if there are transaction costs, diba, they are separately recorded as an expense. And you have to specify, of course, what type of expense, like ano ba siya, commission, brokerage, and so on. Subsequent measurement, meaning after the initial measurement, you're going to measure the liabilities at reporting date. So the financial liabilities at Fvtpl will be measured at fair value, and you have to account for the changes in fair value because remember, this is at Fvtpl, so at fair value through profit or loss. So if the Fvtpl financial liability is held for trading, the changes in fair value through profit or loss will be recognized as unrealized gain or loss in the profit or loss. If it is designated, the changes in the fair value are recognized as either unrealized gain or loss to be presented as follows. So change in fair value not attributable to change in the credit risk, present the unrealized gain or loss in the profit or loss. Again, not attributable to change in credit risk. But on the other hand, if it is attributable to the change in the credit risk, okay, so this would be the presentation. So if it would create or enlarge an accounting mismatch in profit or loss, it shall be present all unrealized gain or losses on that liability, including the effects of changes in the credit risk of that liability in the profit or loss. If it would not create or enlarge an accounting mismatch in profit or loss, present the unrealized gain or loss attributable to changes in the credit risk of that liability in the OCI. Remaining amount of the change in the fair value would be presented in the profit or loss as unrealized gain or loss. So what is this mentioned credit risk? So according to PFRS 7, credit risk is the risk that one party to a financial instrument will cause a financial loss for the other party by failing to discharge an obligation. So, pag naiutang, there would be or there will always be a credit risk because there is a chance that the other party, the one owing or the one in debt, the debtor in the transaction indebted to another might not be able to pay, or might not be able to perform according to the agreement or carry out the contract. So there would be a loss to the other party. So an entity shall determine the amount of change in the fair value of the financial liability that is attributable to changes in the credit risk of that liability, either as the amount of change in its fair value that is not attributable to changes in market conditions that give rise to market risk, or using an alternative method the entity believes more faithfully represents the amount of change in the liability's fair value that is attributable to changes in its credit risk. Okay, if the only significant and relevant changes in market conditions for a liability are changes in an observed interest rate, the amount of change in the fair value of the financial liability can be estimated as follows. First, the entity computes the liability's internal rate of return at the start of the period using the fair value of the liability and the liability's contractual cash flows at the start of the period. So if you can recall our lesson in the management advisory services, particularly in the internal rate of return, which is part of the capital budgeting, diba? So we have already learned how to interpolate to get the IRR. So again, compute the IRR at the start of the period using the fair value of the liability and the liability's contractual cash flows at the start of the period. It deducts from this rate of return the observed interest rate at the start of the period to arrive at an instrument-specific component of their internal rate of return. Then, the entity calculates the present value of cash flows associated with the liability using the liability's contractual cash flows at the end of the period, and a discount rate equal to the sum of the observed interest rate at the end of the period and the instrument-specific component of the internal rate of return as determined in item A. The difference between the fair value of the liability at the end of the period and the amount determined in B is a change in fair value that is not attributable to changes in the observed interest rate. This is the amount that will be presented in the other comprehensive income. So if you're going to memorize the steps, that would be a burden. But if these are being applied in the problem, so if you're familiar na with the steps as they are applied in the problem, it would be a lot easier to familiarize. Okay, here's a reminder, this method would not be appropriate if changes in the fair value arising from the other factors are significant. Okay, so let's go to the illustration. On January 1, 2021, nation's foremost CPA Review Incorporated issued a 4-year bonds with a face value of 2 million for 1,935,152. Okay, so this is your principal and this is your consideration. Okay, this is the value you have received. This is the cash consideration and this is the issued bonds, money imohang gibaligya. So since the issue price here, which is this is the amount you received, is lesser, so there is a discount. Okay, gamay man imohang na receive. So on the date of issuance, the company incurred the bonds carry an interest rate of 8% per year annually, payable on December 31. On the date of issuance, the company incurred and paid commissions to underwriters of 10,000. The bonds are to be appropriately classified as financial liability at Fvtpl. So if there are other expenses such as this one, this is separate. On December 31, 2021, the bonds are quoted at 103%. So the fair value here is greater than 100%. So nisa ka iyang value. How much will be the interest expense for 2021? Okay, for the first question, so you have to get the face value, which is 2 million, and multiply it by the stated rate. This is the stated rate. That's 8%. And of course, since the bonds are issued at January 1 and you count it until December 31 of the same year, that's 12 months. So that's 160,000. That will be your interest expense for 2021. Question 2. How much is the unrealized gain or loss in 2021 to be recognized in the profit or loss? So you have to get the fair value at December 31. So that's at 103%. So the fair value of the bonds is 2,060,000. So that's 2 million times 1.03. That's from the 103%. You will get 2,060,000. And then compare that with the carrying value, which is 1,935,152. And you will get the difference of 124,848. Since the utang increases to 2,060,000 from the 1,935,152, so there is unrealized loss. Next, requirement 3. Prepare the necessary journal entries for 2021. Okay, so here we are the ones issuing the bonds. So kung kitang mag-issue kitay na maligya. Okay, so kung kitay na maligya, so kita ang maka-receive og money. So as I have mentioned earlier, diba, pag ang bonds nato, okay, ang bonds nato is issued at a lower price compared sa ato ang face amount, there's a discount. On the other hand, pag mas dako tag na-receive kumpara sa face amount niya, there is a premium. But since this is a financial liability at Fvtpl, there's no discount, no premium. So mag-discount na ta o mag-premium kung amortized costs. So now let's go to the journal entries. How do we prepare the entries for this one? So here, okay, so this is debit 2. Ang atong consideration here, okay, so that would be debit 2. How much would be our cash here? So ang atong cash, okay, it's 1,935,152. Okay? But kuan siya og 10,000 kay naa may commission expense. So 1,925,000. Okay? And this is cash because kita may namaligya, di ba? Si Nations Foremost may namaligya. So this is cash. Sorry. Okay. I-highlight na lang ako. Okay. Highlight. By the way, this is cash. Butang na lang na to word. Ani? Cash. Not financial liability. Okay. Because if we're going to debit the financial liability, that's going to extinguish. So we got nothing to extinguish because this is the initial entry pa. Okay? And this one, of course, this should be the financial liability. Okay. Fvtpl. Okay, so we need to establish pa the financial liability, di ba? Okay, next. On December 31, we're going to record the interest expense. So this is the amount we computed earlier. Interest expense, credit, cash. And then, since, okay, the fair value of the bonds is 2,060,000. Okay, so increase here. However, the carrying value here, okay, is 1,935,152. Okay. So, nisaka man siya ang yahang value from 1,935,152 to 2,060,000. On our end, that would be unrealized loss. Kung asset pa ni siya, o yan, itaas ang iyang value, ana, niya asset na siya, we will be happy kay muda ko ang value sa tong asset. Pero kung liability na siya, niya ni taas iyang value, we won't be happy kay ni taas mo po na tong bayro nun, di ba? So that's why debit unrealized loss, so that's 124,848, and credit financial liability Fvtpl. Okay. By the way, this one is amounting to, okay, wala pa din na correct, 1935. Okay, so kani 1925 kay 1935,152 minusan sa nagasto nga 10,000. So gi-compound naman siya. Okay, so that is for financial liability at Fvtpl with no changes due to credit risk. Okay, let's go to a Fvtpl with change due to credit risk. On January 1, 2021, Bacolod Company issues a 10-year bond with a par value of 1,500,000 and annual fixed coupon rate, or this is the annual yield, of 8%, which is consistent with the market rates for bonds with similar characteristics. Bacolod uses observed benchmark interest rate at the date of inception of the bonds. This rate is 5%. So, at the end of the first year, we have the following. The observed interest rate has decreased to 4.75%, and the fair value interest rate of the bonds is 7.60%. Bacolod is required to present the effects of changes in the liabilities credit risks in the OCI. First question, what is the unrealized gain or loss to be recognized in the OCI during 2021? So how do we compute that? We have to get the market price of the liability at the end of the period at the fair value interest rate of the bonds, which is 7.60. So we have the breakdown below. So compute the present value of the principal, that's 1,500,000 times 0.5172. We're going to use the interest rate of 7.60, which is the fair value interest rate. Then, use 9 periods. Ano, 9 naman siya because the rate here above is at the end of first year. So, diba, 10 years man ang bonds. So, nakuha na siya 1 year. So, 9 periods remaining. Then, for the interest, that's 1.5 million times 8%. Okay, so the 8% here is the yield, the coupon rate. Then, times 6.35 to 1. So that's the present value of ordinary annuity of 1 at 7.6% for 9 periods. Okay. So this would be your market price of the liability at the end of the period. How about the other component, the fair value liability using the sum observed interest rate, that's at 7.75%. Okay. So how do we get the 7.75? So the 7.75 is coming from the observed benchmark interest rate at the end of the period, 4.75, and the instrument specific IRR, which is the internal rate of return at the start of the period, which is your effective rate in the given problem, that's 8%, and the observed benchmark interest rate at the date of inception, which is 3%. So sum it up, this is our discount rate. So use that 7.75 to get the fair value of the liability using the sum observed interest rate and the instrument specific IRR. So you would get 1,523,688. Okay, then get the difference. So we have the market price at the end of the period is 1,538,000. Then the fair value using the sum observed interest rate is 1,523,688. So your market price is greater. So there is unrealized loss, which will be presented under OCI in the amount of 14,364. Then, what will be the journal entry at the end of the year? So, you have debit to unrealized loss, the amount we have computed earlier. The requirement 2 pa di ay. Requirement 2, what is the unrealized gain or loss recognized in the profit or loss? Kanina sa OCI. So, in the profit or loss, okay, get the market price at the end of the period. So, we have computed this one, 1,538,52 pesos, and deduct the carrying amount of the liability, 1,500,000. So, the increase in the fair value in the financial liability at fair value through profit or loss is 38,052, but we computed earlier na the unrealized loss that will be classified in the OCI at 14,364. So, ang excess adto sa profit or loss. So, the entry at the end of the year would be debit unrealized loss, OCI, 14,364, and debit unrealized loss, profit or loss, 23,688, and credit financial liability at Fvtpl, 38,052. In effect, mo increase ang atoang liability because of the increase in the market price of the liability. Okay, when do we de-recognize a financial liability? So, pag mag-de-recognize ta, so, tangtangon from recognition. So, meaning, it will be removed from the SFP. And kanusaan na siya mahitabo when the liability is extinguished. Kanusaan man ma-extinguish kung ma-discharge, ma-cancel, or ma-expire. So, there would be a gain or loss. Okay, so depende kung gain ba na siya or loss on the derecognition. So, how do we compute the gain or loss on the derecognition? You get the difference between the consideration paid, pilay na bayad nato, o ang carrying amount sa utang. Okay, di ba previously, kita may naka-receive og money pag issue nato sa liability. Just like when we establish, di ba, notes payable, and then nangutang ta. So, mag-debit sa cash for the proceeds. And of course, later on, bayaran man dyan nato ang utang. So, i-close nato ang liability and then credit cash to represent the payment. But for financial liabilities designated as at Fvtpl, the amounts presented in the OCI shall not be subsequently transferred to profit or loss. So, every entity may transfer the cumulative gain or loss within equity. So we have an illustration, the recognition of held for trading debt securities. So Occidental Company acquired 4-year bonds with a face value of 2 million for 1,935,152. The bonds acquire an interest of 8% per year payable every December 31, and these are classified at held for trading. On December 31, the bonds are quoted at 103%. And then on January 3, 2022, the bonds are retired at 104%. Naunsa na ba? Okay, first is compute the realized loss or gain in the sale in 2022. Then record the transaction on the date of sale. So retirement price, atuan na siyang paliton og balik. Kay di ba pag last time kay kita may nag-issue sa bonds. What is the retirement price? So that's on January 3. Okay, pag i-retire na, so tanggalon na nimo from your liabilities, imo na siyang bawion. So kita na yung makabayad. So you have 2 million times 104%. And then you get the carrying value pag December 31, that's at 103, so 2,060,000. So the loss on sale would be 20,000. Journal entry, okay, kay kita na may nag-acquire o balik. So i-close na to ang liability. So financial liability at Fvtpl, so that's 2,060,000. Then loss on the recognition, 20,000 in credit. Cash, 2,080,000. Okay, realized gain or loss of Fvtpl with change due to credit risk. So on January 1, 2021, REO company issues a 10-year bond with par value of 1,500,000 with a coupon rate of 8%. REO uses observed interest rate. The entity is required to present the effects of changes in the liabilities, credit risk, and the other comprehensive income. The fair value of the financial liability is 1,538,52 on December 31, 2021. REO appropriately recorded unrealized loss in other comprehensive income of 14,364 and in the profit or loss amounting to 23,688. The bonds were retired at 104%. What would be the gain or loss in 2022 when you retire the liability? So 1,500,000 times 104% again, so that's 1,560,000. Then compare that with the carrying value, okay, given here. So there's a difference of 21,948. So loss ni siya kay mas dako man tag mabayaran, di ba? Kaysa sa carrying value. So to close the liability, so that's financial liability at Fvtpl, then loss on sale, OCI, and credit cash, 1,560,000. Then, to close the loss previously recognized in the OCI to equity, we debit retained earnings. We have 36,312, which is the sum of the previously recognized unrealized loss in the OCI. That's 14,364. Then, you have the recent loss on sale. So, kailangan tanggalon na sa siya kay i-retire naman si financial liability. 21,948 for a total of 36,312. So financial liabilities through profit or loss should be presented in the current section of the SFP. So our next lesson would be on the financial liabilities at amortized costs, which includes the following: the bonds payable, notes payable, and the loans payable. So this will be discussed in our next video, so kindly click the next video lesson after this one.
If you like this video, don't forget to click like, subscribe, and hit the notification bell to be updated with the latest video lessons. Thank you for watching!